Hi, everyone. With the wildfire risk in California, property insurance is becoming an increasingly complex topic. We're very glad today to have Sterling Fairholm of Reliance Insurance Brokers with us to talk about the basics of homeowners insurance policies. Sterling, would you please get us started by introducing yourself and tell us what you're seeing in the homeowners insurance marketplace today?
Absolutely. Yep. So my name is Sterling Fairholm. I'm the broker and owner at Reliance Insurance Brokers. I have been in the insurance business for about 17 years, on the independent side for 11 of those. And so we've been watching the insurance market change pretty dramatically, especially over the last few years. The current environment, really is as difficult as anyone's ever seen. With the typical insurance companies that people are used to dealing with, mostly pulled out of the market. What we're saying and seeing right now is about 75% of all home insurance companies are not doing business in California right now, which leaves it leaves a hole in the insurance market that other carriers are stepping in to fill. And then obviously with the California Fair Plan being a huge portion of what the insurance market is right now, we're seeing people that are really not aware of what their options are, not aware of someone like myself or the independent market and how those channels work. Often getting bad information that there's no insurance available, or you won't be able to get insurance, or things of that nature, which, just simply, they're not true. They're just more difficult to get than it was, this time a few years ago. Also, unfortunately, costs have also been on the rise. So we're seeing a difficulty in acquiring insurance, and then obviously the costs associated going up.
Okay, so let's get started actually by talking about difference between insurance brokers and I think what's called the captive insurance brokers. Yeah.
Yeah. So there's really three segments of insurance. There's the captive market, which is the State Farms and Farmers and all states and AAAs of the world. They're typically representative of that one company. They have a little bit of leeway, but for the most part, they offer whatever that product is from that carrier. It's typically been a big part of the market. But with State Farm, I mean, all of them in some ways taking a step back and either canceling policies or no longer offering new policies. The captive side has been a bit of a challenge for people. And that's oftentimes where people will call and get the news or find that they're hearing that they're not able to get insurance, but it really just means they can't get insurance with that insurance company. Then there's my side, which is the broker side, which has been around forever. The difference is that we do not work or represent one company. We represent dozens of companies, some of which are doing business, some of them aren't, in California. So it's not a perfect situation, but it does allow more access, more options, and a broader range of products. And then the last side, which is something that's come around probably more in the last couple decades, is the direct writers. Direct writers are your Geicos, Progressives, and those companies that typically work as a 1-800 number. Those direct writers, the only way to work with them is through a call center or online. And typically those companies are going to be pretty isolated in what they can and can't offer, but they are still offering products in California.
Yeah, and if you're working with someone direct, you better know the jargons. You better know the hidden language or the restrictions that they have.
You're building your own policy with them at that point. So one of the biggest drawbacks we see with that direct writer is the call center's probably not in California. It's probably going to be somewhere that isn't aware of the differences of California and what we deal with for reconstruction costs. And a lot of times they're much more worried about wind coverage because of hurricanes and tornadoes, where in California, we're not really worried about wind coverage. We're much more focused on the things that happen more commonly here. So there's a big drawback to the call center option and the direct writers, but it doesn't prevent people from still acquiring. And I will tell people to check some places when I'm working with them if I know there's a better option, but I also make sure that they review the coverages before purchasing.
Great. So Sterling, what's admitted versus non-admitted insurers?
Yeah, so great question. So there's a lot of this going on right now because the non-admitted markets are filling in some of those gaps from the captive markets going away. The non-admitted is essentially, it's a policy that's just like anything else. It's just not reviewed and approved by the state of California. Whereas admitted means that they have been reviewed and approved by the state of California. Now, the problem that people feel like is a concern is that when you're not admitted, you are not backed by the state of California if a company was to go insolvent. There is a backstop with the state when you are admitted if a company was to go under due to a claim, which we did see a couple of those in the Paradise Fire, that there is still money that is hanging out there to fill in the gaps or to make good on the policy that you purchased. Now, on the non-admitted side of things, there is not that backstop. But those companies that are on the non-admitted side do buy what's called reinsurance, and they do get a financial rating. So there are, there's some safety precautions there to know that you're buying it from a company that will be there if you do have a claim. With that said, a lot of the non-admitted markets are massive multi-billion-dollar companies. They're not companies that there's anything to be concerned with. But at the same token, there are smaller non-admitted companies that you're never going to heard of. No one's going to, feel that safe buying from them. And that's where the drawback comes. But oftentimes they are the better options right now.
So where does California Fair Plan fit into that?
Yeah, so what we really think of right now in the home insurance market is three different avenues. So we think of the preferred or admitted market, which is the companies we've talked about. Then there's the secondary or the non-admitted market, which is what we just talked about. And the third line is the FAIR Plan and a DIC. So the FAIR Plan is a fire policy. It covers fire, smoke, lightning, wind, and vandalism. So those are the things that the FAIR Plan covers, which leaves a big gap in things like water, theft, liability, things of that nature. But that all is covered under what's called the DIC, which stands for difference in conditions, which is essentially a normal homeowner's policy that excludes fire, smoke, lightning, wind, and vandalism. So together, those create one homeowner's policy. The FAIR Plan is known as the insurance of last resort. It's not the perfect situation and it's not long-term, but it is something we have to utilize right now because some areas that is the only realistic option, whether that's price or availability of insurance.
Got it. So then let's go specifically into homeowners insurance. What do homeowners insurance cover? Does it cover a new roof, a water line burst, or does it cover home expansion or ADU construction?
Yeah, so homeowners insurance specifically, there's a lot of coverages and too many to list out loud. It's more about what's not covered. And when you're paying attention to homeowner insurance in California, specifically flood and earthquake are never covered by homeowners insurance. The other rule of thumb is to consider that it is not a maintenance policy or a warranty. So it's not going to cover you if a refrigerator dies or your washing machine or dishwasher dies. Those items are covered if there is a fire or something like that, but they're not covered due to maintenance. So you don't want to think of a homeowner's insurance policy as a maintenance policy because if your roof is old and it needs to be replaced, homeowner's insurance doesn't cover that. But to your point, if a water line was to burst in the house and water went everywhere, homeowner's insurance kicks in and it covers not only the repair, it also covers the remediation of any mold and mildew. Also covers for you to live elsewhere while your home's being repaired and any of your belongings that are damaged in that water burst situation. So water is the most common claim in insurance, whether it comes from a roof leak, a water pipe breaking. We see the lines, we call them water lines, and they go between the house and the refrigerator, the house and the sink, the toilets. You see them all over your house anywhere water is distributed. That is the most common claim is going to be water on homeowners. But the main things is paying attention to what's not covered, which are going to be those perils I mentioned earlier. Now, it won't cover construction of an ADU. So if you're trying to buy a home and add an ADU or trying to buy a home and upgrade or improve the home, insurance is not meant for that. Insurance is meant to replace what's damaged in a claim that is covered by home insurance.
Got it. Okay, what about condo policies? How does that differ from a standalone single-family home owner's
I
policy?
mean, the main difference is they all cover the very similar things. There's really no difference other than what you're covering. So on a condo, typically the homeowners association has an HOA policy, and that policy is going to extend to whatever the CCNRs dictate that they are going to extend to. So typically we review the homeowners docs, the CCNRs, to see what what that homeowner association directs you to cover. There's two types of condo policies. There's a walls in policy that covers just the inside of the unit. And then within that, you can be responsible for original construction or improvements. So on a typical condo policy, which is called an HO6, you may have a water leak like we talked about. And the condo association could be responsible of taking care of all the floors and everything that's damaged. And the only part you have to worry about is your belongings. Or the association could say you are responsible from the walls in. And so that means the minute water comes in, whatever happens on the interior of your unit, you're responsible for. So your condo policy would cover the dwelling and the personal belongings. But since you can't cover the structure, especially in a multi-story condo, you can't build one unit. The homeowners association is always going to be responsible for the actual structure itself from what's considered the walls out. So they're going to be putting in the studs and the siding and the exterior. They're going to be responsible for the roof and things of that nature. So the condo policies are really just meant to be a homeowner's policy for the inside only of the unit.
Okay, so I think that means that you will need more time. If you're asked to shop for a homeowner's policy, you will need more time to review the CCNR from the
We're
HOA.
typically going to, yeah, we're going to say, hey, do we know what's being required? Because some of the newer associations or some of the better association policies, they cover everything. And you still want to have a small amount of coverage for the dwelling because their deductible may be $20,000. So you want to make sure that if you have a $2,500 water claim, that you have a little bit for it. But you certainly don't need to have $200,000 of interior coverage if the homeowner association has a good policy. But the only way to figure that out is to get all the condo documents and read through their insurance section.
Got it. Okay, so the next question has puzzled me for years and years. What's the difference between replacement cost and actual cash value?
Yeah, it's a tricky one. It's a really good question. And it comes up often, especially with the fair plan and some of these companies that are now offering only actual cash value depending on the age of roof, which is a big deal. But essentially, RCV, which is replacement cost value, comes in three formats: replacement cost only, guaranteed replacement, which is not available in California, and then extended replacement cost coverage. Replacement cost coverage as a whole means that if you lose your house, they're going to rebuild it and replace it the way it was. And that's the idea, is to replace it the way it was, so that while you are going to be inconvenienced and you're going to be put out, and it's going to probably be a very traumatic situation in a fire, you are going to be made whole, and made whole without anything out of your pocket other than your deductible. The idea is they're going to replace your property. Actual cash value essentially is a short version of depreciation. ACV is what it stands for, but actual cash value means that whatever that amount it would take to rebuild is going to have depreciation involved. And that number is never clear. You're never going to see depreciation of 30%, anything like that, until you have a claim. So for example, on a $1 million rebuild, if you have a claim and the house is a total loss on an actual cash value policy, that means that you may get 700,000, you may get 600,000 to rebuild based on that actual cash value. And they're depreciating based on the effective life of the property. So we see it a lot through the Bay Area. It's not uncommon to see a 100-year-old home. If you have a 100-year-old home and you're on actual cash value, that depreciation is going to be pretty significant. It's going to depreciate a large percentage, and there's no way to know what that number is, which is why we generally stay away from actual cash value in most cases because it's not a good policy. It's not a preferred policy. And truth be told, a lot of lenders won't lend on actual cash value. So you want to make sure that you don't have that issue running into a lending situation.
What about extended modified extended replacement cost?
Yeah, so you can have regular extended or modified extended, but both are going to be a percentage. So we'll go back to that $1 million house and say that a policy comes with 25% extended replacement. That means that in a situation where the home hasn't been addressed in years, which is not uncommon, hasn't been looked at, or in the situation we had with COVID, where the price of lumber doubled, the cost of goods and services doubled, tripled. It's an extension buffer coverage of 25%, 50%. Each of them are different. The high value programs have 100%. And what it's saying is they'll take that $1 million of construction and we're going to give you an extra 25%. So 250,000. And that extra buffer is going to be above and beyond the million. So technically at that point, you have a total coverage of 1.25 million. In the case of 50%, you have an extra 1.5 million. Now, you can't utilize that to properly insure your home. The insurance companies are going to have a minimum that they're going to allow you to insure it for. But you can be a bit conservative with your reconstruction, knowing you have that buffer. But if the home rebuild is $2 million, you don't want to rely on trying to put $1 million plus extended replacement as a way to rebuild, because insurance companies do have fall safes in the backside to prevent underinsuring and relying on extended replacement. The idea behind it is meant to be for unforeseen items and the chance that for 10 years, no one looked at their homeowners insurance and inflation has kicked in at such a dramatic level that you couldn't rebuild for that original dollar amount.
Okay, so what if the building code has changed since we bought the property?
Coverage. Yeah, it's a separate coverage called building ordinance and law. And sometimes it'll be known as code upgrade. It's built into most policies at 10%. So on that $1 million policy, we have an extra 10% of coverage, so 100,000 for code and upgrades. 25% is usually about the most you can get. But the idea behind it is there's things that are going to have to be done to rebuild this home that are something that you weren't thinking about 50 years ago when the home was built. And one of the biggest things now is going to be sprinklers. Any home by code being built right now has to be built with sprinklers. So when you look at a home that was 25, 30, 50, 100 years old, there's no way that it would have interior sprinklers. But if it was to be rebuilt, it would need those. We're expecting at some point in the future that we'll see the same thing with solar. At some point that all new construction will have to have solar. So that means if you have a home that's in a fire, you have to rebuild it. It has to be rebuilt with the current building codes. And so that extra buffer of coverage, which is built in, is going to help rebuild the home, help have more coverage to rebuild the home when there's some deficiencies like sprinklers and so on.
Right. So besides the building code and law, ordinance or coverage, what other endorsements do you recommend homeowners and condo owners to have?
Yeah, so I mean, the biggest one is always extended replacement that we talked about a minute ago. That is one that is very cheap to add. You typically want to take the max that an insurance company will give you. And the reason for that is it's the worst case scenario of a fire losing the home. You want to make sure you have enough to rebuild. And especially in the Bay Area, the cost to rebuild is dramatically high. And what you don't want to be is stuck in a situation where you're under the impression you don't have enough to rebuild. And that extended replacement really helps with that. That's typically going to be built in with most good policies. But of course, if we're going to talk about maybe the unknown or the hidden endorsements people don't pay a lot of attention to, really there's a few, all of which are optional, but you want to make sure you have replacement cost content. So we talked about replacement costs and actual cash value. The same thing can be said for your personal belongings. If you had a theft and your TV was stolen, a 5-year-old television is worth about $3, but you want to replace it. So you're going to have to get a new TV, and you want to have replacement cost so that you can replace the television with a brand new television on the insurance dime. rather than have depreciation. And that goes for all of your belongings. TV is an easy situation to use it as an example, but furniture, clothes, there's very little actual cash value in those items. So replacement cost is very important. And most policies are going to have replacement cost contents, but you have to pay attention to that. Another very common misconception is that water is always covered by homeowners insurance. And that is true in most cases, except for it's water under pressure. So water under pressure goes to what we talked about, which is those lines that run through your house, whether it's a sink line or a refrigerator line and anything that's in the walls. So you spring a leak on one of those, and obviously it can do dramatic damage by spraying water in the walls. You come home, your floor is covered in 2 inches of water. That is a typical coverage of home insurance. What isn't really looked at the same way is what's called sewer and backup drain. And that's gray water. So that is sewer water. And this is also a reasonably common item. The good news with this is it's not under pressure. So it's not spraying out through the house, and it's something that tends to be a little bit slower leak or a little bit slower damage. But in order to cover anything that has to do with gray water, you have to have what's called sewer and backup drain, which is an optional coverage. It usually comes in the amounts of 5, 10, 25 on the better policies. But if you have an overflow in your toilet, that is sewer and backup drain. If you have an overflow in your shower pan and it goes in there, that's sewer and backup drain. We typically see the floors, the vanity, and the baseboards all ruined in a sewer type situation. Those are must-haves or very important. And there's some really nice optional coverages, and this comes up a lot too, which is called service line. So service line coverage endorsements are not available on every policy, but they're available on most. And what this is typically a $10,000 or $15,000 coverage that will help you if you have that pipe that runs from your house to the street collapse, tree roots intrude, and you call Roto-Rooter and realize it's not a backup. It's actually your plumbing has failed, but it's not in your house. It's out in the street. There's a gray area in insurance and with the city. As soon as it leaves the city main and until it hits your house, there's nothing. There's no coverage in there unless you have what's called service line. And that will talk about plumbing, underground electrical wires, anything that has lines or pipes underground, water mains. If you come home and there's a fountain in your front yard that's coming out of your grass from your water pipe, that is going to be your responsibility. So that's a service line option. Typically runs between $40 and $100 per year, which the alternative is you can buy it from your water district often, or your the sanitary district of your area. But they typically charge a monthly and add it to your bill. But the insurance version of that tends to be more cost effective.
So in the housing industry, that's called sewer lateral, the sewer line between the house and the city connection. And it is not uncommon for us to get plumber quotes for $50,000 to $20,000 for the sewer lateral replacement.
Yeah, so there's a thing called repipe, and that tends to be the best option. It tends to fit within, depending on, obviously, if you have 100 yards of sewer lateral before you hit the street, it's going to be very different. The problem is the insurance does typically cap 10 to 15 somewhere in there, and that repipe tends to be in that ballpark. I wouldn't be surprised because it's starting to get outdated. I wouldn't be surprised if over time insurance bumps that number up, but right now it does run between 10 and 15,000, and it does come at a fixed dollar amount, so you can get those service lines, because it is more than just the sewer. Those service lines covered by insurance, which is a nice add-on, not a must, but obviously you want to take into account your situation. Do you have trees all through your front yard, or is it all clear? Have you had your lines cameraed? Yeah, you can kind of do those things, especially as a buyer during inspections and so on. And then oh, I should probably consider that, because this is a ticking time bomb. This could happen anytime. Versus it was clear, it's perfect, and then there's no reason to add it.
Yeah, right now home buyers, if they're looking to close escrow, they just want to get an insurance policy. They don't have time to get a camera into the sewer line.
It's true.
Yeah. Now, so we hear from some of our clients and some of our real estate colleagues that their homeowners policies are getting canceled for different reasons. What are the things that you're seeing right now where homeowners should probably do as a preventative measure to prevent their insurance policies from canceled?
Yeah, it's very common right now, and it happens in two ways. So, on a new purchase, insurance is going to do an inspection, and that inspection will come back with what's called loss control recommendations. The most common recommendations are going to have to do with trees or debris, trees overhanging the house, trees resting on the house, bushes up against the house, depends on how big the fire area is. And then there will be other things like insurance companies will come back and say, hey, we're not going to insure this because the roof is not in good condition, and that the roofs are the biggest culprit right now for cancellations besides in a fire area. And at the end of the day, you can't do anything about an insurance company considering an area too high a fire and canceling you. At that point, it's just a function of finding a company that's still doing business. But preventative measures to make sure that your home isn't targeted by an insurance company doing drone reviews. Drone reviews tend to be the big hot button. It essentially just looks like Google Earth, a little bit closer up, and insurance companies will send a notice saying mold and mildew, moss growth. Those are really big ones. On flat roofs, we hear about ponding. So if they happen to catch it right after a rain and there's a big puddle on the roof, they're worried that it's not draining fast enough or the draining isn't done set up properly. But the roof maintenance and the amount of tree growth around or over the house is a big hot button. What we're seeing from most carriers that have an issue right now, usually if you look at it from above and you can't see the roof because it's covered in trees, the insurance companies are going to have an issue with that.
Great. So, Sterling, anything else you want to share with our clients about homeowners policy, condo policies before we wrap up?
Yeah, I think that the biggest word of advice right now is to, if you're in the market and you're purchasing a home, is to really pay attention to what your options are as you're making your offer, or right when you get into a contract, depending on your contingencies. I know a lot of companies, a lot of realtors, a lot of various situations rely on home insurance contingencies, which we really never had before. I have now started to see realtors require a homeowner's quote as part of making an offer. So I think what people are seeing is the market is the word's out. People know home insurance isn't easy in California. So you want to kind of be prepared. You just want to make your calls, find out what your options are so you don't get blindsided or you aren't surprised after the fact. And the main reason I say that is because if your loan to value ratios are tight or your debt to income ratios are tight, and you need the insurance to come in a certain area to be able to make it work, those are things you can do ahead of time. Call a professional, call a broker, find out what's available for you. And then for people who are currently insured and don't have any problems, most of the time we're saying stay where you are. Don't open a can of worms by making a change unless it makes a lot of sense. There are certain companies that are way overpriced right now, and it doesn't hurt to look, but you don't want to make a change unless it really makes sense to do so, and ask questions. If you are looking at changing insurance, don't be afraid to say, is there anything I should be worried about if I do make this change, or anything you can see that may be a problem? I like to be very upfront and tell someone when I'm looking at their house, and I'll tell them whether it's a purchase or just someone changing insurance, and I'll say, I just want you to know there's a good chance that the insurance company upon inspection is probably going to have a problem with that tree on the left side of your house because the branches are overhanging the roof. Just know that you're going to probably have to do some tree maintenance, some work on that. We'll take a few pictures and get it resolved. But I want to make sure that we're upfront telling people what to expect rather than them get what isn't a friendly letter from an insurance company saying, we're canceling you because you have X, Y, and Z. And that's what you want to be out ahead of. So for people who are getting new insurance, be ahead of it. Pay attention, know what your options are as you're getting into contract. People that are currently insured, there's no reason to rock the boat unless it makes sense. It doesn't hurt to look, but don't make a change for a marginal difference in cost. It's not worth the headache it could create. And then for people getting canceled, just know that you have time. So when you get canceled, it's a 90-day or more cancellation. It is not panic mode. It is not time to worry about, we need it right now. Because the truth is, home insurance quotes are only good for 30 days. So if we talk today about something 90 days from now, we can't even write that policy for 90 days right now. So it's great to get a head start, and it's great to look around and ask questions, but don't be afraid of someone telling you it's too early, because it is. They're not just pushing you off. They should be very upfront and just tell you the truth that insurance quotes are only good for 30 days. So we like to say, here's a general idea of what we'll be looking at. Let's make a plan in the future to pick a time right around or just before 30 days to go over the options, make sure that our dates work, and make sure that nothing's changed. Because we are hoping for change, and we are hoping that insurance companies start to come back into the market a bit more. Most companies have gotten their rate increases that they've been wanting. There's still a lot of uncertainty on what the state of California is going to push on different insurance companies, making them insure in fire areas that are uncomfortable. There's a lot of legislature that we're still waiting to understand, and insurance companies are still waiting to understand, so that they can come back into the market, because realistically nobody wants to be in the market that we're in right now. And a lot of times we're just waiting, buying time. Maybe we write a California Fair Plan policy for a year until the market improves. Those are all real considerations right now in this interesting market.
Great. So Sterling, thank you very much for all the wisdom you're sharing with us on this video. We'll have your contact information as part of this video when we post it on YouTube. And that pretty much does it for this segment, homeowners insurance policy. Thank you to everyone for watching, and please be sure to subscribe and follow us for future videos on this topic. And if you have any specific questions or suggestions for Sterling, feel free to reach out to him or leave us a question in the comment section. We'll be sure to get back to you. Again, thank you, Sterling.
Thank you, Elsie. You take care.